The Shanghai Stock Exchange suffered its biggest one-day loss in over 8 years. China's slowing economy is causing concern around the world. So what's behind this decline, and how is it affecting other economies? This is Inside Story. Hello and welcome to the program. I'm Mike Hanna. It's being dubbed Black Monday, a day in which China's deepening economic troubles sparked a global markets crisis. The Shanghai Composite, considered the epicenter of China's recent market tumble, suffered its biggest drop since 2007, amidst fears of a worsening slowdown in China have spooked investors, setting off a chain of market losses across Asia, Europe and beyond. Before we bring in our guests, Adrian Brown sets up our discussion from Beijing.
The share sell-off began within minutes of the Shanghai Stock Exchange opening. At one point, the index fell by 9%, recovering only slightly. Some of China's biggest companies, which means some of the world's biggest, are listed here. On Monday, the government announced a new and risky intervention to try and prop up the market by using billions of dollars from the state pension fund. But it failed to stop the slide.
How can the markets drop every day like this? 1, 2, 3, 4, 5. The market dropped for 5 days and it never rose back.
Many borrowed to buy shares and are now being forced to sell those shares to pay back the loans.
The Chinese market aims to eliminate the middle class. After eliminating the middle class will have no purchasing power and the market won't be flourishing.
Worse still, the value of their pensions could be at risk if the market's decline continues.
I think the government can solve this problem properly. The government won't spend all the pension money on the stock market.
The government is reassuring investors, but everything it's so far tried to rescue the market has failed. Since June, the Shanghai index has lost more than 30% of its value, and analysts warn the decline is likely to continue. Once more, the drop in Chinese shares dragged down markets across the Asia-Pacific region. The main reason, a fear that the slowdown in China's economy is worse than the government is letting on. The Hong Kong index followed the mainland's sharp decline, closing down more than 5 points. The region's biggest stock market, Tokyo, ended the day almost 5 points lower as well. South Korea closed down by more than 2%, its 6th consecutive loss. And Australia suffered its biggest one-day fall in 4 years, down by more than 4%. What all these markets desperately need, but don't have, is investor confidence. Adrian Brown, Al Jazeera, Beijing.
Well, at this stage, let's bring in our guests. Joining us from Singapore, Fraser Howie, co-author of Red Capitalism, the Fragile Financial Foundation of China's Extraordinary Rise. In London, Alberto Gallo, head of macro credit research at the Royal Bank of Scotland. And in the US state of Connecticut, Peter Schiff, CEO and Chief Global Strategist of Euro-Pacific Capital. Welcome to you all. Let's begin with Fraser Howie. Is this a long overdue market correction, or is it the beginning of another lasting market crash? Your view?
Well, certainly if we're looking at China, this is ultimately the delayed collapse of a bubble that was built up over the past year through a lot of leverage and debt, and one that the government stood in to intervene in about 6 or 7 weeks ago and basically postpone the inevitable. But basically this is a very hard landing of a leveraged and induced bubble. It's come at a time as well where there's very bad economic data coming out of China, and that's caused a contagion effect in Asia and elsewhere around the globe.
Well, Alberto Gallo, your view, are we looking at everything stemming from problems within the Chinese economy?
This is what we call the third leg of the credit crunch. What has almost always worried me about emerging markets is that there's never been a deleveraging. Private credit has grown throughout the crisis at a double-digit rate, despite the credit crunch in the US, despite the credit crunch in Europe. And emerging market sovereigns, but also corporates, have benefited from cheap Fed liquidity and cheap ECB liquidity. So this era has now come to an end. There's been a lot of leverage, a lot of overinvestment into industries and into sectors that are not productive, like real estate or commodities. And now the losses have to be accounted for. So I think there's more downside in China. The government still has some dry powder, but it's very limited compared to the size of the problem. And if you add total debt, public and private, to GDP, you're over 200%. So even though the central bank has some dry powder, it's less compared to the size of the problem. And there's also downside for other emerging markets.
Well, that we're seeing very clearly. But Peter Schiff, some analysts contend that the start point in this process was the devaluation of the Chinese currency as a motivating force in this immediate crisis. Is it that simple, do you believe?
I don't think so. You know, the Dow Jones had fallen for, I think, 6 out of the 7 days prior to China taking that small move. You know, I think the larger bubble is in the United States. And I think what's happening now is we're just going to finish the financial crisis that began in 2008 and which the Fed interrupted with monetary easing, QE, 0% interest rates. The real catalyst for all of this is the false belief that the Fed is about to raise interest rates after leaving them at zero for 6 or 7 years. See, I don't think this is going to happen. I think in order to avoid a worse financial crisis than 2008, the Fed is going to make the same mistake. They're not going to raise interest rates. They're, in fact, going to launch QE4, which is going to be bigger than QE3, 2, and 1 combined. And ultimately, the consequence is going to be a U.S. dollar crisis. That's going to be worse than a financial crisis. Right now, the dollar is falling against a lot of currencies, or rising, rather, against a lot of emerging market currencies, but it is breaking down against the yen. It's breaking down against the euro and other major currencies. And gold is also on the rise. It's risen over $80 in the last 2 weeks. I think these new trends are going to continue. And rather than dollar strength, the real story down the line is going to be pronounced dollar weakness.
Well, I'm going to return to some of those points in a moment. But all of this has raised concerns that China's economic decline could be far worse than previously thought. And that has far-reaching implications, because the world's economies have become increasingly reliant on China to drive growth. The country accounts for 15% of global output, but in recent years it's contributed up to half of global economic growth. As the crisis has unfolded, Beijing has made big interventions to try and shore up Chinese stocks and help the economy. But it doesn't seem to be working. And as a result, shares, commodities and currencies are now under pressure around the world. Well, Fraser Howey, we have heard the analysis as well that what is happening now is in fact a ongoing process from 2008, the last major crash, that there was never any proper lasting correction following that. This is still the problems inherent in 2008 were just masked over the intervening years. Would that be a valid theory, do you believe?
I think it is probably a valid theory, and you could probably even go further back than that. Certainly the Fed's policy, if there's any time there's been a problem in the past 15 years, is just pour more money at it. But certainly if you look at the sort of the end of the party in 2008, there wasn't that sort of clearing out and that sort of capitulation that I think Peter would have expected. And I would agree with him to that extent. But what you also had, when you bring this back home to China, that at the same time there, while China was impacted at the end of 2008, what it did was it just launched a massive stimulus program and built up all that credit from basically the beginning of 2009 onwards. So that basically at the time of the Beijing Olympics, August 2008, China was this miracle growth story. And here we are 7-8 years later, and China is now this debt story because debt and credit has been growing at double-digit rates, outpacing the economic growth it's got. So China's become more and more dependent on credit and debt and cheap money. At the same time, you've got the European nations and the US as well, who've also basically tied themselves to a cheap money era, and it's very difficult to move away from that.
Well, Alberto Gallo, I mean, here we're hearing the theory that post-2008 governments and institutions flooded the market with cash, poured money into various economies. China, of course, benefiting greatly from that infusion of massive capital. Is this one of the major reasons that we are looking at for what is happening today in the crisis that we are facing now?
Yeah, I think it's exactly the reliance on credit growth to create economic growth. Every government has been always choosing this shortcut, over the past more than the past 20 years. Actually, you can trace it back to Freddie Mac and to the housing programs of the 70s in the U.S. Every government was, looking at two choices: reforms or encouraging private lending, encouraging credit, borrowing and creating consumption and growth. Not just in China, but also it has happened in the US, it has happened in Europe, it's happening in the UK now with the housing programs. And so China did the same. China's credit growth trend in the last 5 years looks very similar to Japan's growth trend before the 90s and to the growth trend in private credit in Europe just before the 2008 crisis. So it has been looking like an exponential growth in private credit. The mechanism is very decentralized. It's been working in the local government part, in the provinces of China, which have been targeting certain GDP targets and then boosting real estate investment and capital investment.
Well, Peter Schiff, you wanted to comment something there?
Yeah, well, the problem is that the artificial credit growth engineered by central banks doesn't create legitimate economic growth. It just provides fuel for bubbles. It ends up in malinvestment, and it basically takes us further from our actual goal. And because of all this central bank intervention, we've done tremendous damage. We've dug ourselves into a deeper hole. The problem for China is they've followed America's lead. They've adopted America's failed monetary policy because of the peg of the yuan to the US dollar. What China really needs to do is to break that peg and have its own sounder monetary policy that includes higher interest rates and allows for the appreciation, not the devaluation of the yuan, but the appreciation of the yuan. And the Chinese government, along with the rest of Southeast Asia, has to stop vendor financing the United States. They need to recognize that America is broke. We cannot afford to pay for their exports, and they need to be trading amongst themselves and consuming more of their own production instead of trying to sell what they produce to a bankrupt nation, the United States.
Yes, Fraser Howie, though, yet some would argue that the devaluation of the yuan followed a process in which China was doing precisely what Peter is saying that they should do, that it was actually attempting to allow market forces determine the value of the currency rather than intervention of central authority. This is something that many have been calling for in China for a long period of time, and yet it was precisely this process, it appears, that sparked off the devaluation, which has in turn led to these tremors around the world. Is that a correct analysis of event, do you believe?
For the past decade, China's certainly been largely allowing their currency to appreciate. The trouble is it's not appreciated enough. They've been highly controlling of the appreciation of their currency, which has led to a lot of complaints from the US Congress and others about the currency being undervalued, etc. And of course, they've not allowed it to appreciate because they wanted to keep it still relatively low to attract investment, to make their exports competitive. And so that's a well-trodden path within Asia. And then their activities recently, but they also realize as well that they need to move and embrace markets more if they're actually going to try and use or reform their financial system and reform their economy. And so their recent moves, well, it was a relatively small market move of 3% on the downside, and then they also said they were going to embrace markets more. They haven't really done that either. But I think the real shock in the past few days, or the past few weeks, is not really the 3% move per se, but it's going from it's a binary type of choice. You've gone from certainty about what the Chinese were doing to uncertainty. And I think there are a number of things in the past 6 weeks, 8 weeks in China, with the stock market correction and the failure to sort of successfully intervene there, when you've had the currency sort of debacle recently as well. You have a Chinese leadership that does not look impressive, and it's losing confidence of both Chinese domestically and international investors. And so you put all that together with poor data, etc., and then you have a very, the sentiment has very much changed on China, and it can change very quickly, and that has a knock-on effect to markets.
Well, Alberto, I'm going to come on to you, but I just want to go to Peter Schiff quickly first. You had something again to add there, did you not, Peter?
Well, again, I think the main problem, everybody is overlooking this, is the fact that the weakness is all the result of the markets preparing for an event that isn't going to happen, and that is a normalization of U.S. monetary policy. People think the Fed could raise rates and shrink its balance sheet. They believed in the legitimacy of the U.S. recovery. It is a gigantic bubble. The Fed cannot raise interest rates the way it's pretending it would do without reigniting a worse financial crisis than 2008, because its very policies have simply delayed the crisis and exacerbated all of the problems that underlie the American economy that caused the crisis. So I think when the world comes to terms with the fact that the U.S. is going to have interest rates at zero indefinitely, and that quantitative easing is not over, the Fed is simply paused and they're getting ready to do it again, I think this will be a game changer in these dynamics, because it will send commodity prices higher. It will send all that flight capital out of the U.S. financial markets, out of U.S. treasuries, out of U.S. stocks, back to the markets which it escaped from as people were trying to prepare for higher interest rates, even though they're not going to happen. Everybody is still delusional with respect to the true state of the U.S. economy, which is teetering on the brink of disaster. It is far more vulnerable than it was in mid-2008, before that crisis that took everybody by surprise, except people like me, who have been warning about it for years.
Well, let me go to Alberto Gallo on that. Is that indeed the elephant in the room, the thing that nobody is discussing, your view?
Yeah, no, I think there's a lot of confusion here. So first of all, what we have really seen is, QE is not the root of the problem. The root of the problem is accumulation of credit. And that's not just by central banks, it's by governments that have been encouraging the private sector to take on more debt. Think about Fannie and Freddie, think about the Help to Buy here in the UK, other programs, subsidized credit in China through state banks, subsidized credit in Brazil, and so on.
The
central banks are left with the choice.
Hold on one second, Peter Schiffer. Alberto Gallo, continue.
Central banks are left with the choice whether to cut rates when a crisis happens, and they cut rates, and that becomes the only choice until we arrive to a level of zero and we engaged into QE. The problem is that QE doesn't work. So QE is not inflationary, QE is deflationary, and that's been argued not just by myself, but also by the IMF, by the St. Louis Fed itself. So QE doesn't work because it just creates investment in financial assets, not in the real economy. So it doesn't push companies to hire workers, to invest in new factories, to undertake long-term projects. It creates the willingness to do a trade into bonds, into stocks, not an investment. And that's still what Europe is, and the US. In the Eurozone, investment has come down 18% since the crisis, and still has to recover, even though stocks until a few days ago were increasing to record highs, and yields are very low. So the problem is that we are now stuck in this low interest rate trap that's very similar to Japan. It means that, unfortunately, investment has become allocated to financial assets rather than the real economy. It means that we have strong deflationary trends from the prior crisis, from the overbuilding of industrial capacity in China and emerging markets that still have to be worked out. So we're not going to see inflation recover. We're going to still see a long credit crunch in emerging markets where these assets have lost value. The ghost cities, the real estate investments in China, the industrial factories, industrial plants that are not being used, while the liabilities still have to lose value. So somebody needs to take a loss.
Let me go to Fraser Howie on that particular point that you're raising there, that we are looking at, by this argument, a whole series of illusions that have been created by a channeling of capital in recent years. Would that be accurate?
I think there's illusions around the globe because of money's ultimately being mispriced, or basically people have mispriced risk. So whether it be, you could certainly look to the States, you could look to Europe, you could look to Asia, where there's been incredible sort of illusions and castles in the sky being built for various reasons. In each market, I would say they're very different. And we're basically suffering the hangover now and still wanting or trying to avoid the real downside of what was a very long party on borrowed money, which fundamentally was not creating fundamental change in jobs in the economy. A lot of it was going into financial assets, and this is a very long and drawn-out process. We never really had the capitulation, the collapse, and all the pain that went with it. And of course, there's a lot of good reasons why the Fed had acted as it was. The Great Depression was not something that Bernanke wanted to go through again. But I'm no economic historian, but there was a lot of people who just don't want to go through that depression. They wanted to go through a long recession. But we certainly have not shaken off the ghost of 2008. And we seem to have repeated many of the problems around the globe.
Peter Schiff?
Yeah, as a result of a fear of not repeating the Great Depression, they're going to succeed. Instead, we're going to have something worse than the Great Depression because of everything that the central banks did. And, the inflation is there, and it's going to manifest itself in a big way, particularly in the United States. It's just that the initial inflationary effects of QE was lifting financial assets. Bond prices went up. Stock prices went up. Real estate prices went up. All of that was the initial effects of inflation. But yes, commodity prices were under pressure. Consumer prices didn't really explode, but all of that is coming. All of this inflation will ultimately end up in consumer prices. That will be the final resting place of what's been happening. And right now, it's been the confidence and the faith that central bankers, that they were successful, that QE has worked. When people have to finally realize that it was a complete disaster, that it did not work, and because it did not work, it will be repeated, because the central banks will never admit that they made a mistake. All they'll do is claim that what they did worked, except they didn't do it enough. And they're going to do more of it, and eventually we are going to overdose on quantitative easing. We are going to destroy the dollar, and then you're going to see the impact of inflation, the effects of inflation on commodities, on consumer prices. And of course, by the time that inflation genie is fully out of the bottle, it will be much too late to try to do anything about it.
Well, Alberto Gallo, your view on that rather bleak prognosis?
Yeah. No, I think that's possible in the long run, but I think for now the problem is still deflation and dealing with the overcapacity and the debt overhang. Because again, we still have, with QE in emerging markets, we still have kept alive a lot of capacity in factories, ships, industries that were not supposed to run. They were supposed to be closed, but we kept them alive. Zombie companies. So they're still working, and they're still producing, and they're still keeping prices low. If you think about it, a scenario of a slow decline. So if you got an industry like where you have a lot of capacity, like take shipping for example, what do? You realized you built too many ships, you cut capacity, you scrap some of the bad ships, and actually ship owners scrapped 10% of capacity during the crisis, and then you move on, and then in the next cycle you have prices going up. But what QE and low interest rates have done in many of these industries, metals, mining, commodities, oil, is to keep capacity artificially high with low interest rates. So in other words, the patient, instead of being cured, instead of undergoing a surgery, has been kept alive without an operation for a long period of time. If this is true for the asset side, so factories, ships, and so on, it's also true for the liability side. So there are bondholders that need to take a loss, and that's true for emerging markets. The problem is the workout process of the overvalued assets and the debt that needs to take a loss. The workout process is very long and painful because in emerging markets and also in Europe, unlike in the US, it's all about bank credit. So these are loans that are in bank balance sheets. Mostly 90% of credit is loans. And it takes a very long time to get transparency on the loans and to work out the bad debt. So
well, at that particular point, I'm afraid it's a discussion that will continue and continue and continue. But my thanks to our guests, Fraser Howey, Alberto Gallo, and Peter Schiff. And thank you for watching. If you have any comments about today's show, you can get in touch by going to our program page at aljazeera.com or post your comments on facebook.com/AJ Inside Story or tweet us at AJ Inside Story. From me, Mike Hanna, and the whole team, goodbye for now.